Hi everyone. Here risk management frequently asked questions. You can see here the frequently asked questions which is very important for risk management people who are attempting the exam. Okay, so the first question is, without wasting our time, we will just have a glance of each and every questions. The first is notice money. So what is notice money? Okay, so there are four options given here. They are asking you notice money period is from how to how. Okay, from how till how much it will be. The notice money itself is very short term. Okay, very short term. That is the first option they have given is 1 day. Second is 2 days to 14 days. Third comes the 15 days to 1 year. And the fourth option is to more than 6 months. So friends, now remember here the answer is B. 2 days to 14 days. How you know? See, call money, it refers to when we are getting the funds. Okay, when we are getting the funds, that is call money refers to the borrowing or lending of funds for 1 day. So notice money, therefore, it refers to the borrowing and lending of funds for 2 to 14 days. And term money is the one who refers to borrowing and lending of funds for a period of more than 14 days. So you understood the concept. So here the question is notice money. So what is notice money? First option is 1 day. So 1 day will not come because it's for call money. If the question was for call money, you should say 1 day. The 1 day will be the answer. Here it's given notice money. Notice money means it refers to borrowing and lending of funds for 2 to 14 days. So the answer is 2 to 14 days. Next comes more than 14 days, that is term money. It will represent as term money. So rest all answer will be for term money. So our answer for notice money is B option, 2 days to 14 days. Okay. The next comes the risk management. Risk management means which risk the country risk classification is updated and published by ECGC on dash basis. They are published on which basis? Weekly, monthly, fortnightly and quarterly. So the answer for this is D, quarterly, because the specific organization, what will they do? The ECGC publishes the country risk classification on a quarterly basis. It will not publish on monthly, weekly or fortnightly. Instead, it will publish on quarterly basis. So without wasting our time, we should tick mark the answer for quarterly basis in your exam. So next comes from the exam point of view is the what does the grade A1 under short term rating indicate? I would repeat the question. Listen carefully. What does the grade A1 under short-term rating indicate? The first option is moderate safety. It indicates moderate safety or minimum safety, then highest safety and very stable. So the answer for this is C, highest safety. The grade 1, that is the grade A1 under short term rating. Under short term rating, grade A1 indicate higher safety. Why? Because A1 instruments. So let's say what is A1 instruments first. A1 instruments with this rating are considered to have very strong degree of safety regarding timely payment of financial obligations. Listen carefully. A1 instruments with this rating are considered to have very strong degree of safety with regard to timely payment of financial obligations. So therefore, such instruments carry lowest credit risk. Okay, that is A1. A2 is also there. So see, you need to remember what is A1, A2, A3, A4, D and so on. Okay. A2, your basics should be clear. A2 means the instruments with this rating are considered to have strong degree of safety regarding timely payment of financial obligations. Therefore, it's considered it carries low credit risk. Okay. A3. What is A3 now? A3 is a moderate degree of safety regarding timely payment of financial obligations. Moderate degree of safety. Such instruments carry higher credit risk as compared to the instruments rated in two higher categories, that is A1 and A2. Next, A4 instrument comes. A4 rating is the instruments with this rating are considered to have minimal degree of safety. The safety will be less with regard to timely payment of financial obligations. So such instruments carry very high credit risk and are susceptible to default. Then comes the D category. So what D instruments with this rating are in default or expected to be in default on maturity? So what was the question? Grade A1 rating under short term rating, which means with safety. The answer will be C, highest safety. A1 we have seen they are very strong degree of safety regarding timely payment of financial obligations, and thus they carry lowest credit risk. The last question in this slide is accounts with total per party exposure of dash crores or with business turnover of not less than dash crores can be considered for external rating. I would repeat the question once again. See, accounts with total per party exposure of dash crores or with business turnover of not less than dash crores can be considered for external rating. So there are 4 options given. The first is the rupee 1, rupee 50. Second is rupees 5 and rupees 50. Third is rupees 10 and rupees 25. You can see in this slide. The D, the last option is rupees 8 and rupees 12. So you need to identify first. The answer is, I have already highlighted there. The answer is B, that is rupees 5 and rupees 50. Why? Because see here, anyone who is borrowing the money, okay, let's say anyone is there who is borrowing the money with any limit can get an external rating. Okay, can get an external rating. Which rating? External rating. The exposure limit of rupees 5 crore and turnover cutoff of rupees 50 crores comes into this picture only for the why it comes into this picture? To calculate risk. Only for the main objective is of them is to calculate the risk weighted assets, that is the RWA, risk weighted assets under Basel guidelines. So the borrowers falling under the answer option B, that is rupees 5 and 50, are classified as corporate and the applicable risk weight depends on their external rating. I would repeat once again, for the accounts here, the accounts with total per party exposure of 5 crores, okay, 5 crores or with business turnover of not less than 50 crores. That means it should be more than 50 crores can be considered for external rating. The answer will be B option, rupees 5 and rupees 50. So here in this video, in this slide we have seen the first, second and the third, fourth questions of frequently asked questions. Okay, so you need to read, revise and learn. In a next slide we are having like that more questions. Also in this video we will be covering more than 100 questions which will be helpful for you all to attend the exam. So the next question is, a bank holds a security. A bank holds a security that is rated AAA, that is rated AAA. The rating of the security migrates to A. Okay. So what is the risk that the bank may face? Is the question. So what is the risk that the bank may face? There are 4 options given: market risk, operational risk, market liquidation risk and credit risk. Okay. So see here, the answer for this is credit risk. Credit risk, the D option, credit risk. Why? Because a downgrading of rating is a sign of deterioration in the credit quality of the borrower and hence it's considered as a credit risk event. Please listen carefully. The question is, a bank holds a security that is rated AAA. The bank is holding a security that is rated AAA. Okay, AAA. The rating of the security migrates to A. What is the risk that the bank may face? It's a credit risk. Why? Because a downgrading of rating is a sign of deterioration in the credit quality of the borrower and hence it's considered as a credit risk event. So the next question is, banks initially follow dash for computing the operational risk capital requirements. So which method is the bank following? Which method is the bank following is there are 4 options given. you may be aware of. There are 4 options given. The first is basic indicator approach. Second is a standardized approach. Third comes the market research report, and the fourth is the modified duration. So the answer for this is a basic indicator approach. Basic indicator approach means it's a BIA. It stands for BIA. You know, as the name suggests, basic indicator approach, that is BIA is the basic, is the entry level for calculation of the operational risk capital requirements under Basel guidelines. See, BIA is the entry level, is as the name suggests, it's the basic, it's the entry level for the calculation of the operational risk capital requirements under Basel guidelines. The next question, moving back to the next question. Communication risk is a type of dash. So what is communication risk? Communication risk is a type of dash. The first is interest rate risk. Interest rate risk. Second comes market risk. Third comes the credit risk. Fourth is the operational risk. So the answer for this is last option, D, operational risk. Why? Because this is the risk of losses arising from inadequate or failed people, process or systems and external losses. I would repeat once again, operational risk is the answer. Communication risk is a type of operational risk. Why? Because this is the risk of losses which are arising from inadequate or failed people, process or its systems and external losses. When there is miscommunication between the bank staff and the customer, it would lead to the operational risk. When there is a miscommunication or the communication gap between the bank staff and the customer, it would lead to operational risk. Moving back to the next question, the risk arising owing to non-enforceability of contract against a counterparty is a dash risk. Which risk? It's a legal risk. Why? Because, see, I will repeat once again the question. The risk arising owing to non-enforceability of contract against a counterparty is the dash risk. Which risk? It's a legal risk. Why? Because the banks have a legal risk that an agreement entered into with the borrower may become unenforceable against the borrower. Legal risk is a part of operational risk. I would repeat once again. Why? Because why is it legal risk? Banks have a legal risk that has a agreement, or you can say an agreement entered into with the borrower may become enforceable against the borrower. Legal risk is a part of operational risk. So here too, in this slide we have seen 4 new questions. In our next slide, they will be having few more questions like this. You can be able to know the risk management important questions asked for exam. That is the frequently asked questions asked for the exam. So, next topic, next question is the what is the duration in market risk? Listen carefully. What is the duration in market risk? Okay, so there are given 4 options. They are given 4 options. Duration. So what is duration? Duration is a weighted average maturity of all the expected future cash flows of a security. The weights, that is the weights. The weights being the present value of respective cash flows. Second option is they have given it is a negative or liability sensitive gap. Third option is it is a positive or asset sensitive gap. Fourth is it is the period for which a security is held by the investor. So what is the answer here? What is the duration in market risk? Duration in market risk itself means the answer for this is A option. A option. Duration is weighted average maturity of all the expected future cash flows of a security, the weights being the present value of the respective cash flows. A answer will be there. I will give you an example for this. See, what is duration? Just now I have said you, duration is the weighted average maturity of all the expected future cash flows of a security, the weights being the present value of the respective cash flows. Let us take an example for you. Let's take an example of a 3-year bond which is 10,000. That like for an example, 3-year bond. Okay, 3-year bond for rupees 10,000, which that pays interest, let's say 100 rupees after 1 year, rupees 100 after 2 years, rupees 100 plus the principal. That is rupees 10,000 after 3 years. Okay, so the duration, how will we calculate the duration? See, the duration is calculated as below. You can see here R1. Okay, just remember what I am saying. I would publish this video to see R1. R1 is the rate of interest. R1, R2, R3. R1 is the present value of rupees 100 after 1 year. R2 is the present value of rupees 100 after 2 years. R3 is the present value of 10,100 after 3 years. Listen carefully. R3 is the present value of 10,100 after 3 years. Thus, the duration is equal to 1x R1 plus 2x R2, that is 2 into R2, okay, plus 3 into R3 divided by R1 plus R2 plus R3. You will get the answer. Okay, that's why the duration in market risk is, the duration is the weighted average maturity they will see of all the expected future cash flows of a security, the weights being the present value of the respective cash flows. Moving back to the next question, what is modified duration? What is modified duration now? Okay, modified duration. Okay, they have given you 4 options. The first is the modified duration, which stands for MD. It's a factor by which the value of the cash flow will vary due to the change in the interest rate. The cash flows value will vary, will differ due to the change in the interest rate. Second, it is the measure of price elasticity of debt instrument reflecting the percentage change in the economic value of the instrument for a given percentage change in interest rate. Third comes the both A and B. Fourth option is none of the above, that is none of the A and B. Okay, so what is the answer here? The answer will be C, both A and B. So what is modified duration? Modified duration means it's a factor by which the value of the cash flow will vary due to the change in the interest rate. Also, it's a measure of a price elasticity of debt instrument reflecting the percentage change in the economic value of the instrument for a given percentage change in interest rate. In this slide, we are having 2 questions published. In our next slide also, few more questions will be there. Moreover, you will be having 100 plus questions in this topic, that is risk management topic. So friends, here in this slide there are 4 questions. Just have a look in the slide. So what is PV01? Okay, PV means a present value. So what is present value 01? It's the basic points they are mentioning. So let's see here. See, what is PV01? They have given you 4 options. The first is it is a measure used to describe how a basic point change in yield affects the price of a bond. Yield means interest. The first option is it is a measure used to describe how a basis point change in yield affects the price of a bond. Second option is it's a measure used to describe how a basis point change in interest rates affect the price of a bond. Third is the both A as well as the B. Fourth option is none of the above. So what's the answer here? The answer is A option, that is PV01 is a measure used to describe how a basis point change in yield affects the price of a bond. That is, modified duration measures the impact of a change in interest rate, not yield, on the price of a bond. I would repeat once again. See, PV01 is a measure used to describe how a basis point change in yield affects the price of a bond. Okay. Then comes the modified duration also measures. The modified duration means it measures the impact of change in the interest rate, not yield, on the price of a bond. Thus, the answer is A option. Next question, moving back to the next question. Next is exchange rate risk forms dash. Exchange rate exchange rate risk forms part of. It is a, which part? Is it a credit risk? It's a part of credit risk, market risk, operational risk and liquidity risk. It's a which part? Exchange rate risk itself means market risk. It's a part of market risk. Why? Because see, what is market risk? Friends, what is market risk? Market risk is defined as the possibility of loss to a bank caused by the changes in the market variables like on and off balance sheet, the positions being adversely affected by the movements in equity and interest rate market, then the forex exchange rate and the various prices. Thus, the market risk is further categorized into interest rate risk, foreign exchange risk, commodity price risk, equity price risk. Okay, so the answer for this is, it's a part of, that is exchange rate risk forms part of market risk. Why? Because market risk is a risk which is defined as the possibility of loss to a bank which is caused by the changes in market variables. Which variables? The factors like on and off balance sheet. The on and off balance sheet, the movements in equity and interest rate markets, foreign exchange rates and so on. Thus, the market risk is therefore furtherly categorized into interest rate risk, foreign exchange risk, commodity price risk and equity price risk. Moving back to the next question. The next question is what is the risk weight allotted for unrated corporate accounts? Listen carefully. What is the risk weight allotted for unrated corporate bonds, that is the corporate accounts? There are four options: 50, 100, 75 and 80. Okay, in terms of percentage, 50, 100, 75 and 80. So the answer is here 100. Answer is 100. Why? Because unrated accounts of corporates as defined under the Basel guidelines is 100%. You may note that the corporate borrowers, okay, listen friends, you may note that the corporate who are there, the corporate borrowers who have been rated BB or below or less than BB, they attract risk weight of 150%. That is higher than those that were unrated. Thus, here the answer is B, that is 100% is been allotted for unrated corporate accounts. Next question is EAD. That is, EAD is nothing but exposure at default. Exposure at default. Okay. EAD under risk management refers to dash. EAD under risk management refers to dash. There are four. First is exposure at default. Second is external audit date. Third is expected annual dividend. The fourth is earning at disposal. I have already given you now the answer. EAD indicates exposure at default. Is because what is exposure at default, friends? Exposure at default, EAD. It is the amount that is due from the customer at the time when the default occurs. So thus EAD can differ substantially from a current outstanding in the account. I will give you an example. For an example, let's say a cash credit is there. A cash credit account with low utilization today. Okay, a cash credit account with low utilization today might be drawn to full 100% at the time of default. So on the other hand, what will happen? The term loan outstanding as on date might have come down substantially by the time of default occurs in the account. Okay, and of course, if the borrower does not pay the term loan installments and the installments, then the interest dues, if the borrower does not pay, then the EAD, that is exposure at default, may be more higher than the current outstanding even for term loans. I hope you are getting the topic what I meant to say now for EAD, that is exposure at default. Hello everyone, welcome back. Now See here, this is only a quick recall. I would repeat once again, this is only a quick recall. The 15th question, this is the risk management frequently asked questions. Second part, that's part 2. Okay, so see here, this in this the question number 15. So what's the question? Just look at the screen. Obligator, that is the obligator rating. Obligator rating takes into account various dash. What dash? Is it financial ratios, credit history of the borrower, probability of default, or all of the above? As the answer, you can see it's been highlighted in red color, all of the above. So I will just explain you in short all of the above, how will it come. So see here, the term obligor, not obligator, sorry, I've just mistaken you in the initial. The term obligor, okay, the term obligor refers to the obligor means refers to an entity under obligation to an entity who is under an obligation to repay the loan or the investment. So obligor rating is nothing but it's a general assessment which is based on financial and other features or other traits, including previous defaults to arrive at the current probability of default. Thus the answer is D, all of the above. The next question is experience of, next question, just have a look. Experience of key persons such as director, it's the management level, directors, partners, etc. will form a part of dash assessment. Which assessment will they form? As the answer, you can see it's been management risk. So they will form a part of which assessment? Management risk assessment. How management risk assessment? Not only to know the answer, but to know behind the answer what's the reason. So see here friends. So first option is financial risk, right? So what is financial risk? I would explain you the each risk. Financial risk, what the risk mean? It's normally evaluated on the basis of the analysis of balance sheet and other financial statements, right? The next comes the management risk, which is the answer for this. So what is it? Management risk means is assessed by studying the experience or expertise of the key managerial persons. Okay, that's why the answer is management risk here. Next risk is industry risk. What industry? Industry means it already defines the word industry. By studying the industry trends and prospects, economic and various environment which affect or influence the profit of the respective industry. Thus, industry risk is that. Okay. The last risk which they are mentioned here is business risk. Now, what is business risk? As the name suggests, business risk is regarding the strategic or the important decisions regarding the products or the market segmentations or business development strategy adopted and so on are the business risk. So I have explained you the 4 risk: financial risk, management risk, industry risk and business risk. Answer for here is the management risk. Move back to the next question. Next question is the back testing is done to dash. How is the back testing done? So they have given 4 options here. Just have a look. The first is a tester model. Compare the model results and the actual performance. Third comes the record performance. And the fourth is none of the above which is mentioned. Okay. So what's the answer? Before moving to the answer or before seeing the answer, don't directly jump to the answer as it's been directly highlighted. Just you think once again what will be the answer for the respective question. Okay, see back testing. What is back testing? Back testing, you should know the meaning. Then only you can able to answer the respective question, right? So first learn back testing. What is it? Back testing is simply it's a process of comparing. Okay, what will we compare? Comparing the results predicted by the respective model for a particular, or you can say for a respective term, with the actual results during the period. Okay. See, once again I would repeat the answer. Back test. So back testing, back means previous, as the name itself mentions you, back, that is previous testing. We will see or we will predict this we will predict the future. Okay, how will we predict the future? By predicting the respective model, that is the back testing model for a specific term with the actual results what they have now. Okay, with the actual results during the specific term. is called the back testing. That is, the answer is we will compare the model results and the actual performance. Moving back to the next question in this slide, the last question in this slide, which risk is also called a default risk? So which risk? We need to name the risk which is also named as or also known as default risk. There are 4 options given here: operational risk, market risk, credit risk and interest rate risk. So the answer they have mentioned is C, credit risk. So credit risk, what is credit risk? The possibility of default. Okay, see, listen carefully friends. The possibility of default by a borrower, okay, to repay a loan is a major credit risk for a bank, right? So incidentally, default risk is also applicable in respect to investments, or in respect of investments you can say. If a bank purchases a bond and on the maturity, the issuer of the bond does not pay the maturity proceeds. So what will the bank lose? The entire money the bank will lose, right? So this risk also falls under credit risk and is not considered as a part of the market risk. It will be considered in the part of credit risk rather than market risk. I hope you are able to get the answers. Then in this slide, see, there are 2 questions given. In the first question, just read the question. Don't directly read the answer. Just read the question and the options given. Okay, I will explain you each and everything why this is not the answer and why this is the answer. So just have a look on the question. The four major cause due to which the 4 major cause. Okay, so what is the cause? The operational risk, they are having different segregations. There are different types they are having in operational risk. Okay, which is some major things are affecting those operational risk category. That is the operation risk factors. Okay, so what are they? As they are given 4 options. The first option is process. You can read here. The first option is process, people, systems and external. The second option comes the legal, reputation, concentration and external. The third comes the procedure, people, liquidity and legal. I am going a little bit fast. You just have a look. You just have a look on the screen, because we need to go for the entire risk management questions. That's the reason I'm going a little bit fast, because it will be having more than 150 questions for you in your FAQs, which is very important to see each and every question. Okay. Then the last option was the people, systems, procedures and internal events. So the answer, as you can see here, is the first option, that is the A, process, people, systems and external. So why is it? See friends, operational risk. What is operational risk first? First, let me know what is the operation risk. Every time, whatever question they will ask, the answer will be in that question itself. The name will suggest its answer. Half answer they will suggest. Half we need to think and tell the answer. So see here, operational risk. What is operational risk? Okay, operational risk is nothing but a risk of loss which is resulting from inadequate, or you can say from failed people, failed process, systems or external events. Okay, it includes legal risk. It excludes strategic and reputational risk. Remember one thing, it includes legal risk. It includes legal risk, but it excludes strategic and reputational risk. It excludes strategic and reputational risk. So in the second option, legal is there, but it excludes reputation, right? So this option will not come. Third option is legal is there, liquidity will not come. Liquidity they are excluding. Then the fourth option, they are having internal events. Internal events will not come. Instead of that, external events will come into consideration. So the answer will be the A, process, people, systems and external. Next, moving back to the next question, that is the last question in this slide, which is which category of operational risk events encompasses losses from KYC and guidelines breaches. I would repeat once again the question, which category of operational risk events encompasses losses from KYC and guidelines breaches. There are 4 options given: business disruption and system failures. Second option is the internal fraud. Third comes the execution, delivery and process management. The fourth is the clients, products and business practice. Okay. Now, what's the answer would be there? The answer will be the last question, the last option, that is clients, products and business practice. So see here, why the answer will be last? Because breach itself means breach of confidentiality. Okay friends, breach of confidentiality. Okay, breach of confidentiality of KYC information falls under clients, products, business practice of operational risk events. That's why the answer will be the last option, that is the clients, products and business practice. Then friends, in this question in the slide there are 4 questions. Just have a look here. We will move on one by one. The first question, that is the 21st question, is the strategic risk is a type of dash. So there are 4 options given. So what is the type of strategic risk? Okay, strategic risk is a type of dash, interest rate risk, operational risk, liquidity risk and none of these. Okay, so the answer is D, that is none of the above: interest rate risk, operational risk and liquidity risk. Okay, so just see here. So why it's none of the above, I will explain you now. Strategic risk is a type of dash, right? So operational risk, what is operational risk? Here they have given one option, operational risk. Operational risk itself, it includes legal risk, but it excludes strategic and reputational risk. But it excludes strategic and reputational risk. Okay, thus B is not the answer. B is not the answer. B can be the answer, but here as it includes legal, that is correct, but it excludes strategic and reputational. That's why interest rate and liquidity will not come into strategic risk type. Okay, B will come, but as it excludes strategic and reputational risk, it will not come for the answer. Therefore, B is also not the answer. The answer will be D, none of the above. Moving back to the next question. The risk of prepayments. The risk of prepayments of loans and bonds and or premature withdrawal of deposits is called dash. I would repeat once again, then I will explain you. See, the risk of prepayments. Okay, the risk of prepayments of loans and bonds and or premature withdrawal of deposits is called dash. So then there are four options given. The first is the liquidity risk, prepayment risk, embedded option risk and the credit risk. Okay, so what is the answer? The answer will be embedded option risk. Why? You know, embedded option. So what is that? This is such as the option for a customer, you can say a customer to prematurely encash the deposit, or prepayment of loans creates uncertainty regarding the cash flow from the assets. Okay, the cash flow will, but it will vary. Okay, the cash flow will vary depending upon whether an option is exercised or not. I would repeat once again, this is also an important question. Just mark it as important. Every questions are very important exam point of view. See here, the answer is C, embedded option risk. So what is that? Embedded options such as the option for a customer to prematurely encash the deposit, or he will prepay the loans which will create uncertainty regarding the cash flow from the assets. Okay, the cash flow will vary depending on whether the option is exercised or not. The next question is the process risk. So what is process risk? Process risk means there are 4 options given. Now we will see what is process risk. Process risk means dash. First is transaction risk, operation control risk and model risk. So all of the above. So what will be the answer? Process risk means dash. So what is the answer here? Process risk means all of the above. All of the above. So they will be having transaction risk, operational risk and model risk. Okay, so that is called process risk. Then comes the next question. Next question is you can see the last question in this slide. In the slide there is the last question under the BIA. BIA means basic indicator approach. Basic indicator approach. Under the basic indicator approach, banks in India have to hold capital for operational risk equal to this. You may be knowing, friends, because you are already a banker, so you may be knowing. So see, under the BIA, that is under the basic indicator approach, banks in India, Indian banks have to hold capital for operational risk. which is equal to dash. There are 4 options given, which is equal to, you may be aware of. So dash, that is the 3-year average you need to see. 15% of the gross profit, 15% of the net profit, 15% of the gross income, or 15% of total risk weighted assets. So the answer here is the C option, that's 15% of gross income. 15% of gross income. So C option. So see here, the percentage, that is the 15%, has been prescribed by RBI. Reserve Bank of India has prescribed the so and so term. Okay, it should be that. So answer is gross income. So what is gross income, friends? See, the gross income is defined as, listen carefully, the gross income is defined as net interest income, that is NII, net interest income plus the net non-interest income. Okay, net interest income plus net non-interest income. Okay, as it's mentioned 3-year average, so that the 3-year average of gross income is to be calculated. If a gross income is 0 or negative in any year, you can say, then that has to be excluded, and that calculation has to be the average of the other years only. I would repeat once again, this is important question, but you may be aware of. So just see here, the 15% is prescribed by RBI. Okay, so see, what is gross income? Gross income is nothing but, as the answer is 15% of the gross income. So what is gross income? This is defined as net interest income plus net non-interest income. Okay, the 3-year average, as they have mentioned here, if suppose in the 3-year average, one of the year the gross income is 0, or you can say negative in any year, then that has to be excluded from it, and the calculation has to be done on the average of the other years only. Okay. Then friends, moving back to the next question. So see here, the first question, you can look at the screen and concentrate. The first question, 25th question, objective of liquidity management. So what is the objective of liquidity management? Objective of liquidity management is to dash. Okay, there are given 4 options: ensure profitability, ensure liquidity, either of the 2, that is the either of the A or B. The 4th option is the both, that is ensure profitability as well as ensure liquidity. So what's the objective of liquidity management is? Answer is D, both. That is, it is essential that the banks maintain sufficient liquidity to meet its financial commitments. They may be having, or they are having financial commitments, right? So it is very important for the banks to maintain its sufficient liquidity, okay, to meet its uncertainties. So liquidity comes with a cost for a bank. Holding surplus liquid funds far beyond the requirement would affect the profitability of the bank, right? You may know. See, holding surplus liquid funds. Surplus means it's normal liquid funds, then fine. If the bank is not required so much liquid funds, it's a surplus liquid fund. The extra amount is there, which is far beyond the requirement, would affect the profitability of the bank. So hence liquidity management should also focus on reducing its surplus liquidity to how much is possible for them. They should be able to focus on reducing the surplus liquidity to an extent, you can say, and ensure the maximization of profits Moving back to the next question, the next is banks need liquidity. Why banks need liquidity? As a banker, you may know why banks need liquidity. There are 4 options: meet deposits withdrawal, fund loan demands, both of them, none of them. So the answer is C. Banks should maintain sufficient liquidity to pay depositors. Why? Because see, who may be withdrawing funds, so the banker or the staff should be having that time the amount, okay, so that the bank can pay to the respective depositor either on maturity or before maturity. Bank should also maintain sufficient funds to allow borrowers who have been sanctioned limits by the bank to withdraw money from their accounts to an extent which is permitted by the sanctions. So incidentally, banks should also maintain sufficient funds to repay any borrowing or other obligations that it may have to others. So thus the answer is C, both of them. So banks need liquidity to meet their deposits withdrawal as well as fund loan demands. The next question, moving back to the next question is, what does interest rate sensitivity ratio indicate? See, what does interest rate sensitivity ratio indicate? There are four options. The first is ratio of interest rate sensitivity assets to rate sensitive liabilities. Second is capacity and willingness to absorb losses. Third is securities that can be readily sold for cash. And the last option is none of the above three. So the answer is A. Why? Because see, the question they have asked the interest rate sensitivity ratio. Interest rate sensitivity ratio indicate ratio of interest rate sensitivity assets to rate sensitive liabilities. Assets is equal to liabilities, right? So ratio of interest rate sensitive assets to rate sensitive liabilities. The last question, see, when does call risk happen? So call risk, what is the term call risk? Okay, when does this happen? There are four options. Just have a look there. It happens on account of crystallization of contingent liabilities on account of embedded options. Or the second option, when there is a need to let's say to give someone or to compensate for non-receipt of expected inflow of funds. I hope you understood the word non-receipt of expected inflow of funds. And the third option is when a bank fails to manage its intraday liquidity. And the last one is where changes in market interest rates might adversely affect NIM. Okay, now see here first. See, so when does call risk happens? Call risk, when it happens, the answer is A. Why? Because I will give you an example here. Let's say I will give you an example of call risk. Is that, see, a depositor may close his deposit prematurely, or a borrower may prepay his loan installments, thus upsetting the liquidity calculations made by the bank, right, on the originally maturity schedules. So see here, if a depositor is there, is something investment is going to mature on after 3 months. So bank is not having the funds right now, and the depositor suddenly walks in to the bank and he prematurely closes his deposit, and what he say, I need the money, I need to close the investment. So that time the bank will be upset with the liquidity calculations which they have done on the originally maturity schedules. That means they will be assuming this is the maturity schedule, means that time only they will be needing the sufficient funds, not this time. So if suppose uncertainty occurs, that is the uncertainty is the risk. That's the call risk, is that a depositor may close his deposit prematurely, or on another side you can say a borrower can prepay his loan installments. Both will affect the liquidity calculation made by the bank on the originally, okay, on the originally maturity schedules. So in this video we have covered 14 questions of risk management frequently asked questions. Okay, in a next video we will be uploading more and more questions, which will be total in all it will be covering 150 plus questions for risk management exam point. Hello friends, this is also a quick recall of CAIIB risk management frequently asked questions. This is the third part. Okay, we have released the third part. You see here question number 29. So see, this is the 29th question. The question is leverage ratio is calculated as. Leverage ratio. What is leverage ratio? As answer you can see, I will not read the options. You can see directly the options. So the answer is the one which is highlighted in red color. That is the first option. Okay, exposure measure or its C. Why is it A? It's capital measure or exposure measure. Why is it A? It's because leverage ratio. What is leverage ratio? Leverage ratio has been introduced under, you may be aware of, leverage ratio has been introduced under Basel III as a risk management measure. Okay, so that is nothing but an independent of the RWA. Independent RWA calculation. RWA stands for risk weighted assets calculation method. Risk weighted assets calculation method. So leverage ratio is equal to capital measure or exposure measure capital. For this purpose is tier 1 capital after all regulatory adjustments. Kindly make a note, capital measure or exposure measure capital measure for this purpose is tier 1 capital after all the regulatory adjustments. So exposure measure includes the on balance sheet exposure, off balance sheet exposure, including the derivative exposures as well as the securities financing transactions. I would repeat once again, why the answer is 1 is because see capital measure. So what is capital measure? Leverage ratio is equal to capital measure. See capital measure divided by exposure measure. Okay. Leverage ratio is equal to capital measure divided by exposure measure. Exposure measure. Okay. So what is capital measure? Capital measure in that it will come the tier 1 capital after all the regulatory adjustments. Okay. And what is exposure measure? Exposure measure is on and off on balance sheet exposure, off balance sheet exposure. So on and off will come including the derivative exposures as well as the securities transactions or security financing transactions. So that's why the answer is capital measure divided by exposure measure. Second comes move back to the next one, net interest income. So what is net interest income? They have already given 4 options here. In the exam point I am saying you, see net interest income. So what is net interest income? There are 4 options. The answer is the one which is been highlighted in red color. Don't only see the answer. After that, see why the answer is that. The respective answer, why is that? There will be a reason behind it. We'll just think of that. Net interest income. So what is net interest income? Net interest income is actually the difference between the amount of interest paid as well as the interest earned. Interest earned and interest paid. So the difference is the net interest income. That's why the answer is the last option D. Okay. The next question, a bank expects fall in price of a security if it starts selling the security in the market. See the question, just think the question first. A bank expects fall in price of a security. Okay, a bank expects, what he expects, fall in the means reduce in the price of a security if it starts selling in the market the respective security. So what is the risk that the bank is facing now? There are 4 risks mentioned here. You can see in the screen. There are 4 risks. The answer is market risk. Why is because see the answer will be actually the answer is asset liquidation risk. Answer is asset liquidation risk. But see here first, the answer is market risk. So why the market risk? Market risk refers to the risk of a price of a security falling in general. So what in the question is been asked here, the price fall because the bank is starting selling in the security in the market, isn't it? That is when it is liquidating its assets, right? Liquidating its asset liquidation. Hence the answer is the option C, asset liquidation risk. I hope you are understanding my point. Answer is asset liquidation risk. But asset liquidation risk. But this case in general is a market risk. But as the bank is selling it and he is expecting, the bank is expecting the price fall or reduction in the price because the bank starts selling the security in the market. That's why that is itself means when it is liquidating its assets, asset liquidation risk will come here into force. Okay. So answer is C option, asset liquidation risk. The next one is a fall in the interest rate will make prices of government securities, that is GSEC, government securities. Okay. What will it do? A fall in the interest rate. If an interest rate will reduce, will make the prices of government securities what? Go up or go down, or it will remain the same, or none of these. The answer is obviously it will be go up because the market's interest rate and the price of a fixed income security is always inversely related. Please clear in mind. the market's interest rate, whatever the interest rate of a market will there, as well as the price of a fixed income security is inversely related. It's not directly proportional. It is always be inversely related. If the interest rate falls, the price of a bond rises. And if the interest rate rises, the price of a bond falls. So vice versa. Also make a note that if we are referring to a market interest rate, let's suppose market interest rate and not the coupon interest rate. Okay. I'm just giving you an example. If suppose we are referring to a market interest rate and not the coupon interest rate, which is payable on the security, that normally remains unaltered, or it will not be changed, or it will be unchanged throughout the life of the fixed income investment. Okay. So in general here, as per the question, fall in the interest rate will make the prices of G-Sec will go up. Okay. So in this video, like in this slide, there are 4 questions we have already completed. We'll move back to the next slide with new questions. Now look at the screen. This is our 33rd question. So the question number 33. So what is funding risk? Okay, you can see the options. What is funding risk? See, funding risk. What is funding risk? The name itself says what is funding risk is, as the answer is being highlighted in red color, that is the B option. Okay, just see here. Funding risk is a type of which risk? It's a type of funding. It's a type of liquidity. Name itself suggests funding risk is a type of liquidity risk. So it highlights the risk that like you can say a bank may not be able to raise sufficient liquidity resources to meet its expected and unexpected also outflow requirements at any given point of time. I will just repeat once again what I said. What is funding risk? Funding risk is a type of a liquidity risk. Why? It highlights the risk that a bank may not able to raise its sufficient liquidity resources to meet its expected as well as the non-expected or unexpected outflow requirements at any given point of time. That's why the answer is B. Inability to meet the unexpected outflows like premature closure or non-renewal of deposits. The next comes the risk. The next question comes the risk that originates from mismatches in the maturity pattern of assets and liabilities is called dash. That is very simple. The answer is liquidity. But just see why liquidity. So maturing liabilities. What is maturing liabilities means? Fixed deposit or term deposit maturing on any given date or given day. Okay, so have to be settled by the bank. That is the outflow of funds will be there for the bank, right? So what is maturing assets? Assets means a term loan installments, you can say, due from the customer or from the third person on a given date or given term, or investment in government securities that are maturing. So bank should not give. Someone should give, either government, either some other person. So have to be realized. That is for the bank, it will be an inflow. It will be an inflow of funds for the bank. So if there is a negative mismatch between the amount of outflow as well as the inflow in a particular term, then the bank faces the risk of liquidity. And the bank faces the risk of which? Liquidity. It faces the risk of liquidity because if it will be negative mismatch between the amount of outflow and inflow. Okay, then the bank will face a liquidity risk. The next comes what is exposure measure? What is exposure measure? Exposure. The name itself says what is exposure measure? Exposure measure used for leverage ratio. Please keep in mind exposure measure. I've already said you in our previous slide, not the previous video, previous slide itself I have mentioned you capital measure divided by the exposure measure. Keep link of it. Exposure measure, what it comes on and off balance sheet will come, right? Including the derivative exposures and the security financing transactions. Keep that in mind and be focused here. You will get the answer. See D, that is the exposure measure. What is it? Answer is D, right? D means both A as well as B option. So exposure measure itself means it's used for leverage ratio calculation, which is included on balance sheet exposure, off balance sheet exposure, which will also include off balance sheet. Off balance sheet exposure. Off balance sheet will include derivative exposure as well as the securities financing transactions. Securities financing transactions. We will move back now to the next slide. In that we are having more questions. We will just solve the one. Now see here, my dear friends, just see here. Now we are in the 36th question, that is question number 36. So read the question first. Funding of long-term assets by short-term liabilities. Long-term assets by short-term liabilities, it will create dash risk. It will create which risk? It will create a liquidity risk. Okay, but why it will create a liquidity risk? See, if the long-term assets are funded through like raising short-term liabilities, it will create liquidity risk, right? The short-term liabilities, as I said, will have to be settled on their maturity unless they are rolled over, or it may be replaced by new liabilities raised to facilitate the settlement. Otherwise it will be a liquidity risk for the long-term assets. So see here, funding of long-term assets by short-term liabilities. Okay, long-term assets, for funding them by short-term liabilities, it will create a liquidity risk. It's because, see here, if the short-term liabilities will have to be settled on the maturity, it will create a liquidity risk. Or else, if it's not maturing or it is not settled on the maturity, then they may have been rolled over, or it may be replaced with the new liabilities. In that case, it can raise to facilitate the settlement. If a short-term liabilities are not rolled over, or the bank is not able to replace, you can say replace them by raising fresh liabilities, then it may find it difficult to settle the matured liabilities. Thus, the long-term assets may have to be liquidated with adverse impact for the bank. Moving back to the next question, which committee is responsible for the product pricing both for deposits as well as the advances, in addition to monitoring the risk levels of the bank? Which committee? Committee itself is it's only a one committee, that is Assets Liability Management Committee, ALCO will call. Okay. See, which committee? So, committee's name is ALCO. Assets Liability Management Committee. Assets Liability Management Committee. See, which committee is responsible for product pricing both for deposits as well as the advances, in addition to monitoring the risk levels of the bank? So, answer is B. Why? Because ALCO is responsible for managing the assets and the liabilities by fixing the interest rate he will fix on both advances as well as on deposits. Moving back to the next question. The second last question of this slide. The main components of market risk are dash. See here, the main components of market risk. Market risk will take into liquidity risk, interest rate risk and currency risk. These three risks it will come in force. Okay, so the answer they have given in 4 parts. See, A, either it will be only 1, that is liquidity risk. Either it will be 1 and 3 in liquidity and currency risk. Either it will be C option, that is all the three: interest rate, liquidity and currency. And the fourth option will be 2 and 3, interest rate as well as the currency risk. So the answer here is C option, that is all the risk will take into force, or it will come into force as a part of market risk. Okay, moving back to the last question of this slide. Dash is the difference between the RSA and RSL. See, what is RSA? Rate sensitive assets. Rate sensitive assets. RSL, rate sensitive liability. So dash is a difference between the rate sensitive assets and rate sensitive liabilities, and is said to be positive when RSA is greater than RSL. There are 4 options given. So the answer is the first one. Why? Because interest rate sensitive gap is defined as RSA, risk sensitive assets minus risk sensitive liabilities. Risk sensitive assets minus risk sensitive liabilities. Now friends, this is our last slide for the video. Just see here, we are in 40th question. Read the question. Bond with BBB rating, that is bond with BBB rating will carry lower interest rate than one with AA rating. Is it true? No, it's false. Than compared with double A rating, it's false. Okay, see why? Because double B, what is double B indicate? Double B rating borrower is more likely to be default than the double A rated borrower, right? As the default risk is higher, the credit risk for the bank is investing in a double B rating, you can say like triple B rated bond, is also higher. Now the higher risk has to be compensated, right? It has to be compensated by a higher interest rate on the bond when compared to an double A rated borrower. That's why this is true in nearly all cases, and hence the answer is A. It's false here. However, there will be exceptions. In everything there will be a few exceptions to the general rule. I will give you one exceptions to it. For an example, let's suppose if the triple B rated bond offers tax concession, okay, tax concession for the let's say for the investors, then the interest rate on the bond would be lower. Definitely, then the interest rate on the bond would be lower. But in general, if we see, bond with triple B rating will always carry lower interest rate. Okay, will always carry lower interest rate than the one with double A rating. It will be true? No, it will be always false, because double B rated borrower likely to be more default risk, more at risk than the double A rated borrower. Then moving back to the next question, that is expand IRRBB. Expand IRRBB. That is the full form of IRRBB. So what is IRRBB? It refers to IRR means interest rate risk. BB means banking book. Keep in mind clearly, IRR interest rate risk on BB banking book. Interest rate risk on banking book. The banking book is together with the trading book represents the total balance sheet of a respective bank. Now see here, trading book. What is trading book? I am making you clear the concept. Trading book, for a purpose of, let's say, capital adequacy calculations, it consists of the following. There may be securities would be there. There may be securities held for trading or securities under the available for sales category. There may be different categorization, sales categorization, trading categorization. There may be for open foreign exchange limits, trading position in derivatives, derivative entered hedging trading book exposures, and many are there. So for this called in the trading book, it will be there. So derivative transactions entered into by the bank for hedging a banking book entry are also considered or are also a part of the banking book. Thus IRRBB is nothing but interest rate risk. IRR, interest rate risk on banking book. Moving back to the next question, which of the following statements is correct in respect of assets under trading book? So see, there are given options here. The answer is the last option, that is D. B and C will D option comes the options B and C above. So what are the options B and C? We will see here now. See, assets in the trading book does not or do not include investments meant to be held till maturity. See, held till maturity means HTM securities. Held till maturity. That means HTM securities. Keep in mind the term. Assets in trading book do not include investments meant to be HTM. That is held till maturity securities. The assets in the trading book are M to M regularly. M to M means mark to market. M to M. That is also one of the terminology which you need to understand. See, the assets in the trading book are M to M and not HTM. HTM means held till maturity. MTM means mark to market regularly. So what is that M to M? M to M means calculating the current value of the asset as per the current market price and providing for appreciation or depreciation, any will be there as per the guidelines they will provide. So this is M to M. The next question, the last question will be interest rate. Is the interest rate risk is a type of dash. Interest rate risk. Okay, IRR is a type of which risk? Dash. The answer is market risk. Why? Because it's a type of market risk. It addresses the main question, how the bank will be affected if the interest rate changes. If the interest rate will change, like lower, higher, anything. If the interest rate will change, how the bank will address, or how the bank will be affected. So what it will say, interest rate risk is a type of market risk. Interest rate risk is a type of market risk. Now see here friends, in this slide there are 4 questions. The first question, we will read the first question. Okay, read. Dash is defined as a measure of the variance of domestic currency value of an asset, liability or operating income that is attributable to unanticipated change in the exchange rate. Okay, you can see the question first. Okay, see what is being given. There are 4 options also given. The answer for this is foreign exchange, the foreign exchange risk. So why foreign exchange is because it's about domestic currency value of an asset, liability, operating income that is attributable to unanticipated, which is not been anticipated or forecasted, the change in exchange rate. Exchange rate itself means foreign exchange risk. Foreign exchange risk. Thus the answer will be foreign exchange risk. But why this risk is because that the movement in the exchange rates between two currencies may adversely impact the status of it. Okay. Then the next question, investment in post office time deposit is dash. Which risk? Investment in post office itself means zero risk. Okay, itself means zero risk because it's a government. It's a which risk? Zero risk. It's no risk. So the answer is A, zero risk. Why? Investments in as well as investments in guaranteed by Government of India, that is government securities, are considered as having zero risk from credit risk angle. If you see from credit risk angle, it will be zero risk. Next comes 11% Government of India, that is 11% of GOI, Government of India security is quoted at rupees 110. The yield, that is the interest, will be dash. How much will be the interest? Okay, see 110, 11% is the rate of interest, Government of India security. So it will be, the answer will be, how much the answer? The answer will be 10%. It's defined here itself because it's been 110, 11%. So see here, yield, that is B. Why? Yield is calculated as the income received from the investment. Yield, how is being calculated? Income which is received from the investment divided by the price of the instrument. Okay, what is the income? What are the income received from the investment divided by the price of the instrument? Thus, the security pays rupees 11 and cost rupees 110. Therefore, the yield will be, can say the income received from the investment is 11 divided by the price of the instrument is 110. In percent, if we say it will be 10%. So answer will be B, 10%. The next question is, see, ICAAP means, that is ICAAP. The full form is, there are 4 options given. What is ICAAP? As a banker, you may be aware of what is ICAAP. See, there are 4 options given. The first option is internal capital assessment adequacy process. Second is internal capital adequacy assessment process. Third is international capital adequacy assessment process. Then the fourth option is imaginary capital control assessment process. Now, which is the answer here? The answer is B, because all banks are required to have an ICAAP in place. All banks are required to have an internal capital adequacy assessment process. All banks are required to have an internal capital adequacy assessment process in place. Okay. Now, in our next slide, there will be few questions regarding the risk management frequently asked, which is important for your upcoming exam. Hello friends. Now In this class, we will see risk management. That is, in this video, we will see risk management frequently asked questions for CIIB bankers. Those who are going to write the exam for the upcoming exam, risk management paper. It's a part 4 we have released. Okay, you see here, this is our 48th question. Just read the question. Any term deposit for value of dash crore and above is defined as bulk term deposit as per RBI guidelines. Now just see here, there are 4 options given. You can see in the screen, the answer is also been highlighted in red color. Don't see directly the answer. Just read the question by yourself first. Then go for the answer which we have been highlighted. The D, that is rupees 1 crore. So why 1 crore is because, why the answer is D, any deposit of value rupees 1 crore or above is considered as a, which deposit? Bulk deposit is considered as bulk deposit. Okay, therefore any term deposit for value of 1 crore and above is defined as bulk term deposit as per RBI guidelines. Thus the answer is D, rupees 1 crore. Moving back to the next question. That is, premature payment of a term loan will result in interest rate risk of which type? Of dash. That is embedded option risk. Why? Because see, embedded option, what is that? Embedded option brings uncertainty into the calculations. It brings uncertainty into the calculations, as the inflow and the outflow of funds, inflow or outflow of the funds could be different depending upon whether the embedded option is exercised or not. I will explain you this. See, premature payment of a term. Okay, premature payment of a term loan will result in interest rate risk of dash type. It's an embedded option risk. Why? Because the word embedded option, it brings uncertainty into the calculations. Which calculation? Funds calculation. Which funds calculation? Inflow or outflow of funds. Either of the one could be different depending upon whether the specific embedded option is exercised or not. And the next question, right to buy under currency options is currency option. Okay, right to buy. Buy means it's always call option. If it's sell, that means put option, rest. So right to buy. Buy means call. Buy means call. Okay, so that's why the answer is call option. The holder of a call option has the right but not the liability to buy. Please make it clear. The holder of a call option has the right but not the liability to buy the underlying asset at the strike price, at the exercise price. Okay, the opposite of it, right to sell, is known as which option? Right to sell is known as put option. Why? Because the holder of a put option has the right but not the liability to sell, because it's a sell, to sell the underlying, that is the sell the underlying asset at the strike price of the option. Strike price is nothing but the exercise price of the option. In this slide there are 4 questions. Moving back to the next slide, we are having more questions. See now friends, here the 52 question number 52, expand ICC MCS. So what is ICC MCS? Okay, what's the full form? There are 4 options given. International Conference of Capital Measurement and Capital Standards. Second is International Convergence of Capital Measurement and Capital Standards. Third is the International Conference of Capital Measurement and Capital Stability. And the last option is Indian Convergence of Capital Measurement and Capital Standards. Now what will be the answer here? ICC MCS. This is a main term. So what is the full form of ICC MCS? The answer is B. International Convergence of Capital Measurement and Capital Standards. ICC MCS. International Convergence of Capital Measurement and Capital Standards. So what is this? This is a document which is released by the Basel Committee on Banking Supervision. It's called BCBS, Basel Committee on Banking Supervision, and is the foundation of international approach for capital adequacy standards across the world. Okay, that's why. Let's see here, ICCMCS, International Convergence, IC, International Convergence of what? Of capital measurement and capital standards. So this is a document which is released by the Basel Committee on Banking Supervision, BCBS, and is the foundation of the international approach for capital adequacy standards across the world. The next question of this slide is, what does RCSA refer to? What does RCSA refer to? RCSA means what? There are 4 options given. It is based on risk. So the answer is B. Risk and Control Self-Assessment, RCSA. Risk and Control Self-Assessment is a standard tool for operational risk management. This is very important question. Risk and Control Self-Assessment, RCSA, is a standard tool for operational risk management. Under this, that is under RCSA, is a product, you can say a product or a process or an operational risk area is selected and studied to identify the inherent risk involved. The control measures are been applied or has been applied that are in place to mitigate the risk. So the effectiveness of these controls and the net resultant residual risk left to be faced by the whom? By the bank. Okay, I would repeat once again. The answer for this is B. Risk and Control Self-Assessment, that is RCSA. It's a standard tool for operational risk management. Okay, under this you can take anything, any operational risk area or any product or any process which is been studied and it's been identified. Why it's been identified? To identify the inherent risk involved in that, and accordingly control measures are being taken place that are in place to mitigate those risks. So the effectiveness of these control risk, that is the control measures, and the net resultant residual risk left to be faced by the bank. Now look here friends, this is our 54th question. Just read the question first. Failing to take appropriate measures to protect assets, like for an example, IPR, intellectual property rights owned by the institution, is covered under which risk? Is covered under, it is the legal. So that's why legal risk. Every institution should have a necessary copyright and other measures in place to legally defend its intellectual property rights, IPR, and hence it is classified as legal risk. Okay. However, friends, listen carefully. However, failure failure to protect the assets, say failure to renew the insurance of a branch premises, or you can say a cash in transit, could fall under operational risk, not under legal risk. Okay. So what falls under legal risk is an institution should have its necessary copyright and other measures in place to legally defend its IPR, and hence it's classified as legal risk. However, failure in general to protect the assets, say the failure to renew the insurance of the branch premises or cash in transit, could fall under operational risk and not under legal risk. Okay. Then what is classified as process management? What is classified as process management, even types of operational risk? What is classified as process management, even types of operational risk under Basel II? There are 4 options: accounting errors, fiduciary breaches, vandalism, product defects. So the answer is the first, accounting errors, is because see, Basel II category of operational risk event. Basel II category, okay, listen, keep in mind, Basel II category of operational risk event types include execution, it's included execution, delivery and process management, that is EDPM. Yes, EDPM, execution, delivery and process management. So execution, delivery and process management. E stands for execution, D indicates delivery, P indicates the process M indicates the management. Thus EDPM, execution, delivery and process management. Then the transaction capture and execution is one of the subtypes under this EDPM. Thus the accounting errors fall under this subcategory. Fiduciary breaches and product defects too are operational risk events, but they fall under the main category claims. Understood the difference, friends? See, accounting errors fall under this subcategory. Which subcategory? The EDPM subcategory. Okay, accounting errors. Thus the answer is accounting errors. And with regard to the fiduciary breaches and the product defects, these two are in operational risk. That is the operational risk events, but they fall under the main category. Okay, main category. Then products and business practices category also they fall. That is the main category. Which category? Main category means the clients, products and business practices category. The next option, that is the vandalism. What is that? This is also an operational risk event under the main category of damage to physical assets. Vandalism is damage to physical assets. Okay. The next question, moving back to the next one. Which one of the following is not one of the pillars under Basel II? Which one of the following? Minimum capital requirement, supervisory review and evaluation process. These are the in part of the Basel II pillars. So the question is which is not. Okay, market discipline. Market discipline is also there. Market review. Market review is there? No. Okay? So the answer is D. Market review is not there. So answer is D. So the three pillars under Basel II are the minimum capital requirement, supervisory review, evaluation process and market discipline, not market review. The last question of this slide is CRAR. CRAR. Friends, what is CRAR first? CRAR is capital to risk weighted assets. RWA, risk weighted assets ratio. Okay. See, CRAR, capital, that is C stands for the capital to risk weighted assets. Risk weighted assets stands for RA. Risk weighted assets, then R, ratio, risk weighted assets ratio. Okay, the capital compromises of tier 1 capital. This is just for your information I am saying you. CRAR is a tier 1 capital plus tier 2 capital after adjustments as per regulatory prescriptions. Please keep in mind the capital compromises of tier 1 capital plus tier 2 capital. Okay, tier 1 plus tier 2 after adjustments as per regulatory prescriptions. After adjustments as per regulatory prescriptions. Okay. Hello friends. Now see here in this class, risk management, frequently asked questions. This is our part 5. Okay. Now we are in 58th question. Let's read the question and concentrate first. Let's read the question, because question and answer you will get here itself. Question and the respective answers for the question. But what you don't get is what is the answer and how the answer derived, or what is the reason behind the answer. That I will explain you. In each and every question I will explain you. First see, now read the question. If the risk in a business, okay, if the risk in a business or investment is netted against the return from it, then it is called what? Dash. Okay, if the risk in a business, if a risk in a business or an investment is netted against the return from it, then it is called dash. There are 4 options given: net income, net interest income, return on investment and adjusted return on investment. So the answer is, as you see, it's highlighted in red in color, D option. So why the answer is D, that is adjusted ROI, adjusted return on investment. So why is it that? If the return from a business or investment is netted against the risk, then it reflects the risk adjusted return on investment. Okay. However, the word netted, which I have stated you now in the question, netted, may not be fully appropriate in this context, as the risk adjustment could be calculated in an integrated way. Okay, I'm just explain you in short. See, why the answer is adjusted return on investment. Why is it? Because it reflects the risk adjusted return on investment. When the return from a business or an investment is netted against the risk, then it reflects the risk adjusted return on investment. Okay, but the word netted may not be fully appropriate in this context, in this question, as the risk adjustment would be calculated in an integrated way. Next, the next question, moving back to the next question, you can see in the slide, which book includes all the advances, deposits and borrowings which arise from commercial and retail banking. Okay, I would repeat once again, just have a look, see in the slide, which book includes all advances, deposits and borrowings which arise from commercial and retail banking. There are four options: banking book, trading book, account book and ledger. So the answer is the first one, that is the banking book. Why banking book? You know, because the trading book for the purpose of capital adequacy calculations. Okay, the trading book for the main objective or the main goal of them is uh, to calculate the capital adequacy, which is segregated in different. That is, they will be having, which this I have already explained you. Still, I will explain you this. See, which consists of securities under HFT category. HFT is nothing but held for trading category. Then it also comes securities under AFS, that is available for sale category. Open gold, that is the open gold status limit and position limit. Then the forex position limit, trading positions in derivatives as well as derivatives which are entered into hedging trading book exposures. So all these items include advances, deposits, borrowings, which in the question itself they are mentioned, investments held under HTM, held to maturity are a part of the banking book. Thus the answer is banking book. So derivative transactions enter into by the bank for hedging a banking book entry are also considered as a part of banking book. Now see here, moving back to the next question. See, trading book. So what is trading book? Trading book, it includes all the assets that are marketable. Is it true or is it false? Answer is true. Yes. Essentially, trading book will actually it include assets such as the GSEC, that is the government securities, bonds, debentures, shares, etc. that could be bought and sold readily. Okay, so assets such as term loans, cash credit loans given by the bank are not tradable and hence are not a part of trading book. Okay, so what is mentioned here, trading book includes all the assets that are marketable. Marketable means, yeah, it's true, because trading book will contain the assets such as government securities, the debentures, the bonds, shares, etc. that can be bought right away and sold right away, that is bought and sold readily. So, but assets such as term loans and cash credit loans, that are not tradable. These are tradable. Okay, I hope you are getting the point. See the next question, all the assets and liabilities of trading book are normally held until maturity. Held until maturity, HTM, held until maturity, and accrual system and accrual system of accounting. And accrual system of accounting is applied. Is it correct or false? Is it true or false? So the answer is B. Answer is B. Why? Because all the assets and liabilities of banking book, okay, of banking book and not trading book are normally held until maturity and accrual system of accounting is applied. This question is correct, but not trading book. Trading book, as they have mentioned, that's why the answer is false. If they have mentioned banking book, the answer is right. The answer is true. Now we will see in this slide. This slide has four questions. The first question is on question number 62. Read carefully. Read the question. See in the screen. Basel II, that is Basel II has introduced the advanced internal rating based approach. Basel II has introduced the advanced internal rating based approach for credit risk. Okay. Under this, banks will input their own what? What will they input? Their own. They are giving options, either probability of default, either probability of default and loss given default, or probability of default, that is PD, and exposure or at default, or the last option, that is the probability of default then the loss given default and exposure at default. So the answer is the last one. You can see the one which is highlighted in red color, D option. But why the answer is D? Okay. So Basel II has introduced the advanced internal rating based approach for credit risk. Under this approach, the banks will input their own what? Under this, the banks will input their own that is the probability of default, then loss given default and the exposure at default or exposure of default. Okay. Now see here, under this approach for credit risk, the bank can calculate and use their own probability of default, loss given default and exposure at default. However, under foundation, that is under FIRB, FIRB stands for Foundation Internal Rating Based Approach. Foundation Internal Rating Based Approach. The bank will be using the LGD, that is loss given default, and EAD, exposure at default, as specified by the RBI. The next question. Read the question. Operational risk arises from where? Okay. Operational risk arises from inadequate or failed internal process, people and systems, external events, defaults. Which of the following is true? Okay. They are given options. A, all of them are true. B, none of them are true. C option 1, 2 and 3, and D option is 1, 2 and 4. Okay. Now see here, the answer is C, that is 1, 2 and 3 are right. See, operational risk. What is operational risk, friends? Operational risk losses are defined as, they are, like you can say, there are the loss which are arising from inadequate or failed internal process, people, systems or external events. So defaults by the borrower falls under credit risk and not under this risk, that is not under operational risk. Moving back to the next question. See here, type of risk in which payments are interrupted by intervention of foreign governments is considered as which risk? Foreign government. So that the name itself specify its country risk. Okay. So see here, why? Because the risk affecting expropriation. Okay, expropriation, that is expropriation is nothing but transfer of funds or assets of funds from one country to an outside country, or from this country to an outside country, which falls under this risk, that is the country risk. Moving back to the next question. See, risk which arises all activities from contingent liabilities and assets is considered as which risk? Is considered as dash, that is considered as off balance sheet risk. Why? Because contingent liabilities, that is the name of a bank, that is contingent liabilities of a bank, as per bank are included in off balance sheet section of its financial statement. In the bank's financial statement, it will be included in off balance sheet section. Okay. So this risk arising from these contingent liabilities, the risk arising from these contingent liabilities are referred to as off balance sheet risk. Now, in this slide, there are also having 4 questions. Look at the screen. That is the question number 66. So 66 question, just read carefully. Derivatives. So what are derivatives? Derivatives are nothing but swaps, futures, forward contracts and options. So these are dash. These are what? On balance sheet, off balance sheet, none of the above. So these are B, that is off balance sheet exposure. Why? Because off balance sheet exposure, it consists of the items such as LC, that is LC means letters of credit and guarantees. It also includes liabilities, assets under derivatives, namely swaps, options, forward and future contracts, options, etc. Thus, they are called off balance sheet. So, derivatives which they have asked the question, for that the answer is off balance sheet exposure. Then next question. In the case of country risk, bank can adopt the country risk classification given by the following agency. Which agency? This is very simple and important too, my dear friends. Just see, in the case of country risk, okay, the name itself suggests country risk. Means what? The banks can adopt the Country risk classification given by which agency? ECGC agency. Always remember ECGC agency. Why? Because ECGC, it provides country risk classification on which basis? You should remember, this is a main term. It provides the classification on 3 months basis for use by the banks. That is on the quarterly basis. So quarterly basis they have been providing the classification for use by the banks. Then the next question, returns on zero risk investments are generally dash as compared to the other opportunities available in the market. So see here, I will repeat once again the question. Returns on zero risk investment. Returns on zero risk investment are generally dash as compared to other opportunities which are available in the market. There are 4 options: very high, high, low and unpredictable. For this the answer is C, low. Why? Because see, when the risk is low, the reward will also be low. Generally, high risk investments have to offer higher returns to compensate, let's say, to compensate the high risk, high return, to compensate for the higher risk involved in that. Okay. Then the last question in this slide, expand ECAI. Expand ECAI. ECAI is External Credit Assessment Institutions. External Credit Assessment Institution. See, ECAI. The answer is also A, External Credit Assessment Institution. Now, what are these? This is also assessment. Like this is also a rating agency who assess the credit worthiness of an organization and assign them a score, a grade or a rank that indicates the general credit worthiness of a borrower. So these credit ratings assigned by ECAI, that is External Credit Assessment Institutions, are considered by prospective investors, lenders including the banks in their investment or credit appraisal. Okay, because examples of ECAI, that is, you may know CRISIL, CARE, ICRA, Brickwork, then Caiib. These are all the examples I am giving you for credit. These are the credit information agencies who assign rank or a credit score for individuals. Okay. Now see here, look at the question here in this slide. Swaps can be of 2 types. Swaps can be of 2 types, a dash or and dash. Okay, so there are options given here. You can see the options. The answer is A. Why? Because that is, the swaps can be of 2 types, a currency swap or an interest swap. So see here now, the answer is foreign currency swap. What is foreign currency swap? Is an agreement to exchange the principal as well as the interest payments of a loan in one currency for principal and interest payments of a loan of equal value in another currency. So an interest rate swap, that is foreign currency swap. In first answer, first fill up, that is the first blank, you should write foreign currency swap. What is this? This is an agreement to exchange the principal and interest payment of a loan in one currency for principal and the interest payment of a loan of equal value in another currency. Okay. Now see in the second blank, interest. Okay. As I said you, an interest rate swap. So what is this? Swap means exchange. It's an agreement between 2 counterparties in which one stream of future interest payments is exchanged for another based on a specified principal amount. Okay, I hope you are getting my point. Coming back to the next question, prudential guidelines of RBI. Okay, prudential guidelines of RBI allow investments in shares, convertible bonds, debentures, units of equity, oriented mutual funds and exposures to VCFs, that is venture capital funds, up to dash of the net worth of the bank. So what is the answer? Up to how much? 20%, 25%, 15% and 12%. The answer is 20%. The answer is 20%. And the next question, the loss forecast calculated by the where, that is value at risk. The loss forecast calculated by the where is compared with actual losses at the end of the specified time horizon. I would repeat once again, this is also an important question. Mark this also as an important. The loss forecast calculated by where is compared with the actual losses at the end of the specified time horizon. Okay, time period. Whatever the loss forecast is calculated by where is compared with the actual loss which is occurred at the end of the specified time horizon. Okay. So this process is called dash. This process is called back testing. This process is called back testing. Why? Because back testing is simply a process of comparing the results predicted by a model, and that is the where is been predicted a model. Okay, where is a model which is predicted where, that is the actual loss, the loss forecast, the where has been predicted. So this result will compare with the actual loss for a specific time horizon. Okay, that is called back testing. Back testing of where is the answer. Then the last question in this slide, how forward rates are calculated. See, listen carefully. You can see in the screen how forward rates are calculated. There are 4 options given. The first is by adding a markup to spot rate. Second, by adding premium or discount to spot rate. Third, by deducting premium or discount from spot rate. And the last option they are giving is by adding premium and that is by adding premium to and deducting discount from spot rate. Okay, they are adding premium to spot rate and deducting discount from spot rate. So the answer is D. Yes, D. The spot rate forms the basis. The spot rate. What is the spot rate? The basis for calculating the forward rate for any currency. If the currency is trading at premium, for an example, if let's say currency is trading in premium or at a premium, the premium is added to the spot rate. And vice versa. If the currency is trading at a discount, the discount is deducted from the spot rate. So whether a currency will trade at premium or discount, it depends on the number of factors, which includes interest rate prevailing in the 2 countries whose currencies are involved. Okay. Now, in this slide, move back to the 70th question. In this slide contains 4 questions. 70th question, you just look at the screen and see the answers as well as the options. I will only tell you what is the answer and what is the reason behind the answer. Okay, see, who is the regulator for credit rating agencies? Because exams are very near, the upcoming exam, that is the risk management paper is very near. So we have got 150 plus questions of risk management. You can have a look, it will be published in YouTube. See here, this is our 5th part of risk management. CAIIB risk management frequently asked questions which are very important for your upcoming exam. So just see here, who is the regulator for credit rating agencies? Credit rating agencies, who is the regulator? SEBI. The answer is A, SEBI. SEBI is the regulator for credit rating agencies. However, RBI grants accreditation separately to the SEBI registered credit rating agencies. This you may know. However, see, RBI grants accreditation. They grant accreditation separately to SEBI registered credit rating agencies, and only those that have been accredited by RBI may be relevant for certain regulatory instructions which are specified by RBI. Then comes the next question. Move back to this 71 question. Question number 71. The 71st question is, what is the beta factor for retail banking under the standardized approach? See, what is the beta factor? They are asking what is the beta factor for retail banking under the standardized approach. Okay, under the standardized approach is TSA. The standardized approach. So there are given 4 options, 15%, 18%, 12% and none of the above any percent. So the answer is 12%. C, because the following are the, I will give you some lines. See, the following are the beta factors which are prescribed under the standardized approach, that is the standardized approach TSA, for calculation of capital charge for operational risk. For calculation of capital charge for operational risk. Now see here, business line and its beta factor follows which one? Like for the organization finance is there, it will be 18%. Trading and sales, it's 15%. Sorry, it's 18%. Retail banking is 12%. They are asked here retail banking, which is 12%. Then they are having some like agency service is 15%. Retail brokerage is 12%. For asset management is also 12%. Retail banking, see, retail brokerage and asset management are considered to have low operational risk. Retail brokerage and asset management are considered to have low operational risk, and hence it affect a beta factor also of only 12%. Incidentally, under the BIA approach, that is the basic indicator approach, the banks can use 15% as the alpha factor for all the business lines. As the alpha factor, not the beta factor. Alpha factor. Beta factor will be 12% for retail banking. Next, move back to the next question. Which is not the method for computing capital requirement for credit risk? Not operational risk, credit risk. See here, which is not the method. Okay, they are given 4 options. Standardized approach, this is the method, right? Then foundation internal rating based approach, foundation internal rating based approach, FIRP approach, advanced internal rating based approach, C, and the D is basic indicator method. Now see here, the answer is the last, basic indicator approach. That is the basic indicator method or approach. Now see here, what is it? This is the method for computing capital charge for operational risk and not credit risk. Okay. This is the method for computing capital charge for operational risk and not credit risk. Then the next question is like that, similar to that. See, which is not the method for computing capital requirement for operational risk? The previous question was of computing credit risk, and this is of operational risk. So the options are the same, and that is standardized approach, basic indicator approach, standardized approach, and advanced measurement approach. So the answer is A, that is standardized approach. The following are the methods for computing the capital requirement for operational risk, like see, BIA, that the basic indicator approach, BIA, basic indicator approach, TSA, the standardized approach, then comes AMA, advanced measurement approach, and SA, that is standardized approach, is for the credit risk. Okay, so the answer here is standardized approach. Okay, standardized approach. Now see here, 74th question. Look at the screen. Which agency is not identified credit rating agencies, that is external by RBI for capital charge calculation? There are 4 agencies names are given. Onicra is the answer. Onicra is not an RBI accredited credit rating agency for capital charge calculation. Onicra is not an RBI accredited credit rating agency for capital charge calculation. The full list of RBI accredited credit rating agencies is as below. See here, CRISIL, CARE, then comes CRISIL, CARE, ICRA, India Rating, then that is the Brickworks, and so on. Okay, Onicra is not there. Onicra is not there. Is not an RBI accredited credit rating agency for capital charge calculation. Then the next question, see, which is used to convert the amount of a credit line and other off-balance sheet transactions like guarantees and letter of credit, with the exception of derivatives, to an exposure at default amount. Okay, so the answer is, there are 4 options given here. Now see, the answer is C. Why C? That is the credit, why C is off balance sheet items. Okay, off balance sheet items like LC, that is letter of credit, and guarantees represent contingent liabilities. However, it is expected that like some of the contingent liabilities will crystallize into actual liabilities for the bank. So based on various analyses, CCF is nothing but credit conversion factor. Credit conversion factor has been prescribed by RBI for various types of off-balance sheet items for calculating exposure levels. So this CCF, that is the credit conversion factor, it varies depending upon the type of exposure. What is the type of exposure, and sometimes the period of, that is the horizon of exposure also. Now see here the next question. 12% Government of India security is quoted at 120. This type of question we have already seen here. See, 12% Government of India security is quoted at rupees 120. Okay. If the interest rate goes down by 1%, the market price of the security will be dash. If the interest rate goes down by 1%, so what will be the market price? That is the market price of a security. It will be B, 133 decimal 30. That is the, see here, current yield is equal to, what is current yield is equal to the coupon rate divided by current market price into 100, as we need to see in terms of percentage. So we'll divide it, that is 12 divided by 100 comes 120, which is equal to 1200. 1200 divided by 120 is equal to 10%, okay, which is equal to 10%. So now the interest rate, if it went down or it reduced down by 1%, that is 9%, 10%, 9%. So by applying the same formula which I said you, that is current yield is equal to coupon rate divided by current market price CMP into 100. Okay, so now see here, CMP is 1200. Okay, 1200 divided by 9 is, it will be equal to 133.3. That is 133.30. Interest rate is inversely proportional to the market price. Interest rate is inversely proportional to the market price. Next comes the adequacy. Now see here, adequacy of a bank's liquidity position depends upon what? Adequacy of a bank's liquidity position depends upon the sources of funds, the anticipated future funding needs, and the present and future earning capacity. So the answer is D, all of the above. Why D? Because the bank should have sufficient and preferably diversified sources of funds. Okay, it should not come from one source of fund, it should come from diversification. The bank should have sufficient and preferably diversified sources of funds to meet the anticipated outflow of funds during any time horizon. Now this is CIIB risk management frequently asked questions part 6. Dear friends, kindly remember, this is only a quick recall frequently asked questions for the upcoming exam CIIB risk management. Okay, this is our part 6. Now see here the question number 82. Look at the screen. The first question is, the first step of risk management is dash. The first step of risk management is dash. There are 4 options given. Explore the ways to reduce risk. Then features, that is categorize threats. Third is identify risk. Fourth is assess the vulnerability. Answer is C, identify risk. Then the next question is a debenture of face value rupees 100 which carries a coupon rate of 15% if the current yield is 12.5%. So what is the price of the debenture? Okay, see debenture, okay, debenture is there, FV, that is the face value is 100 which carries an interest rate, that is the coupon rate is 15%. So if the interest rate is 12.5 instead of 15, so what will be the price? So answer is 120. But see how 120 we received or we got. Current yield, friends, it is the income from investment. Which investment? Both interest and dividend. It is divided, that is the income from investment coming from interest and dividend is divided by the price of the bond. So current yield, that is the Y, you can say Y is equal to I divided by P. P is the price of bond, I is the income from investment. In this case, what we will do is the interest came from the investment or interest received earned from the investment is rupees 15. As the coupon is paid on the face value. So the current yield is given as 12.5%, which is stated here itself in the question. So therefore 12.5% is equal to 15. That is the yield. Yield is equal to 12.5% is equal to 15. That is the income earned from investment divided by the price of the bond. So we need to find out the price of bond. That is price of bond will be equal to, we will cross multiply 15 into 100 divided by 12.5. So the answer will be 120. Answer will be 120. We will upload practical examples of risk management. For the risk management paper, we will be uploading the practical exam, that is the practical exam point of view, practical questions, that is solved questions will be uploaded in the YouTube. Coming back to the next question, moving to the next question, growth fund. What is growth fund? Growth fund is a mutual fund that dash. Growth fund is a mutual fund that assures growth in income or invest in fixed income securities, gives fixed return, or invest primarily in equities. Now see here, growth fund. Growth fund means the answer is to invest. Growth fund itself means equity. It indicates only equity, high risk, high return. It indicates only, growth fund indicates only equity. So invest primarily in equity. Growth fund itself, it invests primarily in equity. That's why it's high risk, high return. The growth fund pays little or no dividend. The benefits for the investor comes mainly through the appreciation in the value of the units of the fund. So the investment in fixed income securities offer normal return which are expected to be lesser than those offered by the equity investments, because here risk will be less as compared to the equity investments. Equity investment offers the possibility of higher returns, albeit with higher risk. That is also think, if higher returns means higher risk. Therefore, growth funds invest in equities. The last question in this slide is, when can an European option be exercised? There are two options, right? American option and European option. So when can an European option be exercised? So there are four options at the time of entering into the option contract. Second, at any time during the period of option contract. Third is the only at the maturity of the option contract. Fourth comes the after the expiry of 1 month from the beginning of the contract. So here, see, an European option can be exercised only on the date of expiry of the contract. Date of expiry of the contract. So American option contracts can be exercised at any time on or before the expiry of the contract. So if European option they have asked, you should write it can be exercised only on the date of expiry of the contract. This option to be tick mark. C option, that is only at the maturity of the option contract. Only at the maturity of the option contract. Now see here our question number 86, that is the bank shall not invest more than -% of the unit capital of an REIT, that is nothing but real estate investment trust, and INVIT, that is IT stands for infrastructure investment trust. So how much percent? 10%. 10% is the answer, 10%. So how 10%? See here, banks can invest in real estate investment trust and infrastructure investment trust within the overall ceiling of 20% of their net worth, which is permitted for direct investment in shares, then convertible bonds, debentures, units of equity oriented mutual funds, and exposures to venture capital funds, both registered venture fund and non-registered or unregistered. However, the investment cannot exceed 10% of the unit capital of real estate investment trust and in infrastructure investment trust. Thus, the answer is C, 10%. Okay. Moving back to the next question, under Basel II, capital requirement under the accord is dash. Capital requirement. So, capital requirement is what? Under the accord is it the maximum capital that is required to be maintained, or the minimum capital that is required to be maintained, or the C option, the capital as specified by the regulatory authority is required to be maintained? D option is none of the above three. Now see here, the answer is C. The capital as specified by the regulatory authority is required to be maintained under Basel II guidelines capital requirement. So what is that? It's a 8%. Minimum capital of 8% of risk-weighted assets has been prescribed under Basel guidelines. However, the banking regulator in each country can specify their own appropriate minimum CRAR ratio, and naturally this has to be, that is obviously this has to be adhered by all the banks operating within the jurisdiction of that country. So RBI here has prescribed CRAR as 9%. Moving back to the next question, that is, how does the Basel III framework aim to strengthen the global capital framework? So how does the Basel III framework aim to strengthen the global capital framework? There are four options given. You can read one by one. See, the first option they have said is supplementing the risk-based capital requirement with leverage ratio. Second is raising the quality, consistency and transparency of the capital base. Third comes the introduction of a new liquidity measurements like liquidity coverage ratio LCR and net stable funding ratio. Fourth comes all of the above three. Answer here is all of the above. D option. Why? Because see here the important implementation, the key implementation of Basel III includes the following, like stricter guidelines for qualifying as Tier 1 capital. Second comes the introduction of leverage ratio. Third is the liquidity coverage ratio and net stable funding ratio. And fourth comes CCB, that is nothing but capital conservation buffer. Introduction to capital conservation buffer requirements and counter cyclical capital buffer CCCB buffer. Now question number 89. See here, look at the screen. There are four questions in this slide. We will see one by one. The first question here in this slide is, what is the minimum leverage ratio as per Basel III? Yes, look at the screen. I will move little fast. Look at the screen and the options, the answers. I will only let you know what is the answer and what is the reason behind the answer. What is the minimum leverage ratio as per Basel III? There are four options given: 1%, 3%, 2% and 4%. Okay. So what is the minimum leverage ratio? Is 3%. Why? Because the Basel III has prescribed 3% as the minimum leverage ratio. However, RBI has prescribed the minimum leverage ratio as 4.5%. Okay. But here as per Basel III they have stated. So Basel III as per that 3%. Okay. Then moving back to the next question. What constitutes economic capital? What constitutes economic capital? Risk capital, cash flow, regulatory capital or none of these? Risk capital is the answer. Economic capital is mostly treated as synonymous with risk capital, is equal to risk capital. Why? Because it's the amount of capital estimated on the basis of risk. That's why risk profile of a bank. It's known as a risk profile of a bank. Then how many pillars are listed as per the Basel II capital adequacy accord? How many pillars are listed as per the Basel II capital adequacy accord? There are three pillars. See here, three pillars. The three pillars under Basel Accord are capital adequacy requirements, supervisory review and evaluation process market discipline. Capital adequacy requirements are supervisory review and evaluation process market discipline. The last question in this slide, BIA under operational risk refers to BIA. We have already studied in our previous questions. You can go back to the first or the second part, you will get the answer. BIA is nothing but basic indicator approach. Basic indicator approach, that is what? Banks in India are required to adopt one of the following approaches for calculation of their capital charges for operational risk. So this is one of the approach, basic indicator approach. Second is TSA, standardized approach. That is the standardized approach, TSA. See, that is it. Third one is AMA, advanced measurement approach. And incidentally, the AMA, that is the advanced measurement approach, is now been discarded, and revised standardized approach, that is the RSA, revised standardized approach, has been proposed by the Basel Committee on Banking Supervision. Now, the question number 93, that is, see here, what should be the maximum amount of CCB, that is counter cyclical buffer as per Basel III. So what should be, I would repeat once again the question, what should be the maximum amount of counter cyclical buffer as per Basel III? There are four options given. Is it 2.5%, 3.5%, 4.5% and 5.5%? Answer is 2.5%, A option. That is, see here, why? Because the maximum counter cyclical buffer, CCB, the maximum counter cyclical buffer, CCB, which is prescribed under Basel III guidelines, is 2.5% of the risk weighted assets. The CCB is to be maintained as CET1 capital, Now, next question, going concern concept. So, going concern concept, what is that? Is it a method of inventory valuation, or statutes ensuring that the management changes are continuous, or it's an assumption that a company will continue in the business for the foreseeable future, or it's a status governing the procedures for management changes? So what is going concern? Going concern concept is nothing but C option, that is an assumption that a company will continue in a business for the foreseeable future. So going concern, what is that? Going concern takes a view that a company will continue its business for the foreseeable future. On the other hand, gone concern, it views the status of a company if it has to cease and wind up its business operations today. Okay. Then comes the next question. What is meant by rating migration? What is meant by rating migration? There are four options given. That is changing rating agency. Second is changing the rating model. Third comes changes in rating over a period that when rated on some same model. And the fourth option is changes in fee to rating agencies. Now, which option is it? What is meant by rating migration? Rating migration means itself, think in mind, changes in rating of a borrower over a time horizon when rated on a same model. So, same model. So, C option. Rating migration, it simply refers to the changes in the rating of the borrower over a time horizon when rated on the same model. Moving back to the last question in this slide, which one is the comparison of future cash inflows to its future cash outflows over a series of specific time period? So there are four options given. ALM, asset liquidity management, stress testing, maturity ladder, and the fourth option is back testing. Answer is C, maturity ladder. See, why? Because the maturity ladder is a series of time buckets as per the example. That's for the following example, like day 1, day 2 to 7 days, day 8 to 14 days, day 15 to 30 days, day 31 to 2 months, 2 months to 3 months, 3 to 6 to 1 year, 1 year to 3 years, then 3 years to 5 years, like that over a 15 years. The inflow and outflow of funds are examined one by one and are placed in their respective time buckets. Now, in this slide, see carefully the question. This is a practical question. A bank has the following position. Okay, a bank has the following position. See here which position. Tier 1 capital 500 crores. Tier 2 800 crores, right? Next is RWA, risk weighted assets for credit risk, is 5000 crores. Capital charge for market risk 275 crores and capital charge for operational risk 180 crores. Then the CRAR, regulatory CRAR, they have specified is 9%. So see here, the question they have asked is, what are the RWA, risk weighted assets for operational risk? See, risk weighted assets for operational risk. Before seeing the answer, see here, capital charge for operational risk is 180 crores. 180 crores. Operational risk, they were mentioned in the question itself, it's given 180 crores. So 180 right there. Then regulatory CRAR, they have specified 9%, that's in India. Then RWA, that is the risk weighted assets, we need to find out. RWA is equal to the capital charge divided by CRAR. So capital charge is 180 divided by CRAR is 9%, that is 9 divided by 100, 0.09. 180 divided by 0.09. It will come 2000 crores. It will come 2000 crores. The next question in this slide, the last question in this slide is, bank has a paid up capital 100. Listen carefully, look at the question. Bank has a paid up capital 100, free reserves 300, then the provision and contingent reserves 200, revaluation reserves they are given 300, PNCP share is 400, subordinate debt is 300. So what is the risk weighted assets for credit and operational risk? Both they have given is 10,000, and risk weighted assets for market risk 4,000. So based on the above given data, we need to find out the minimum capital to support credit as well as operational risk. So 4 options they have given us. 4 options, see here, is the minimum capital to support credit and operational is 900, or the minimum capital to support credit and operational is 1111.11, or minimum capital to support credit and operational risk is 990, or the minimum capital to support credit as well as operational risk is 600. So the answer we will find out now. Minimum capital, okay, minimum capital to support credit and operational risk, okay, is risk weighted assets of credit and operational risk. So see here, what is the risk weighted assets for credit and operational risk? So they have given here 10,000. So 10,000 into, that is multiplied by the CRAR. CRAR 9%. CRAR is 9%. So see here, 9% will come at 0.09. So 10,000 multiplied by 0.09, it will come as 900. It will come as 900. So the answer is A option. Minimum capital to support credit and operational risk is 900. Now see here, this is our last slide for this video. Now see, this is our question number 99. Read the question and listen carefully. Which process is assessing their capital adequacy based on their risk profiles as well as strategies for maintaining their capital levels? Which process? They are asking us the process. Which process is assessing their capital adequacy based on their risk profiles as well as strategies for maintaining their capital levels? There are 4 options. ALM process. Second is ICAAP, Internal Capital Adequacy Assessment Process. Third is Internal Capital Audit Process, and fourth is none of the above 3. Answer here is second option. Second, that is the B, Internal Capital Adequacy Assessment Process. Internal Capital IC. Adequacy Assessment Process. AAP. So Internal Capital Adequacy Assessment Process. What is this? This is a process for assessing the capital adequacy based on the risk profiles as well as strategies for maintaining their capital levels by the bank. Now we will see here this question. The next question. A bank, this is also a practical question. Listen carefully, understand. A bank has the following position. Okay, a bank has having the following position. See here, it's mentioned Tier 1 capital 500 crores, Tier 2 800 crores, Risk weighted assets for credit risk 5000 crores, capital charge for market risk 275 crores, capital charge for operational risk is 180 crores. Regulatory CRAR is 9% for India, 9% for India in this country. It will differ from country to country. What are the risk weighted assets for market risk? 4 options they have given us. So we need to find out the RWA for market risk. So see here, before looking the answer, just see how to solve. Capital charge for market risk. Capital charge for market risk, they have mentioned is how much? 275, right? So 275 crores. So as per that, CRAR ratio is 9%. Capital charge is multiplied by 100 divided by 9. Capital charge, listen carefully, capital charge is multiplied by 100 divided by 9, or you can say 11.11% to get the risk weighted assets for market risk. Okay. So now see here, risk weighted assets for market risk is equal to, take that answer, 11.11. 275 is the capital charge for market risk, right? Capital charge for market risk. Take that answer in the numerator, multiplied by 11 decimal 11, multiplied by 11 decimal 11. So see here, in the numerator it will be 275, then comes numerator, then comes the multiplied by 11.11, which will come into, no sorry, not the numerator, you will write directly the answer. 275 is the capital charge for market risk, multiplied by the answer which we received now, 11.11. So answer will be rupees 3055 decimal 25 crores. 3055 decimal 25 crores. So the answer is C. 3055 decimal 25 crores is the answer. So till now here we have completed 100 questions of CIIB risk management frequently asked questions, which is very important before you attempt your upcoming exam. More 50 questions, more 50 plus questions are there, which we will be uploading one by one.